America is standing on the edge of an economic cliff, and this September it may finally fall. Since 2021, the US economy has clung to an illusion of stability, but beneath the polished headlines lies a crushing reality: trillions in debt growing faster than the system can handle this. September alone, more than $9 trillion in US Treasury bonds are set to mature, and here's the terrifying part: there may not be enough buyers to absorb them. If confidence cracks even briefly, the debt market could seize up entirely, not just a sell-off, but a default cascade that could paralyze global finance. Over the next 4 years, the government must refinance nearly $28 trillion, but where will Trump find that kind of money if America's top creditors are walking away? Japan, the largest holder of US Treasuries, and China, the third, are both stepping back, and Trump, he's alienated them. Both interest payments have already shattered the $1 trillion mark, now exceeding military spending. Washington can't borrow its way out. The Fed can't hike or cut rates without triggering panic, and investors, they're quietly dumping long-term bonds and bracing for the fallout. If these maturing bonds aren't rolled over, we're not looking at a recession, we're staring down a generational credit collapse. Financial repression is already creeping in: forced low interest rates, frozen capital, locked savings. This isn't speculation, this is the plan, and while the public is distracted by election noise, inflated job reports, and empty inflation headlines, the real fuse has already been lit. America may be just 90 days away from a catastrophic credit shock. So why is no one talking about this? Why are the biggest banks slashing bond exposure while the media keeps saying everything's fine? Something historic is coming this September, and if you're not prepared, you will feel the impact. Before we dive into the full breakdown, make sure you're subscribed so you don't miss what comes next. Since the economic turbulence of 2021, one investment strategy has towered above all others: not tech stocks, not commodities, not even treasuries. The safest, most consistent move has been raising cash. Institutional investors, hedge fund titans, and even cautious asset managers began hoarding liquidity like it was oxygen before a fire. And the reasons were obvious in a world whiplashed by inflation shocks. Fed whiplash and geopolitical tremors, the only reliable safe haven was cold, hard dollars. This is why investors like Warren Buffett are leveraging heavily on cash and winning. He recently sold off huge holdings of stocks and now holds over $300 billion in cash through his company Berkshire Hathaway. He wasn't just being careful, he was sending a strong warning. Buffett sold off many stocks and stayed far away from long-term bonds. Even more shocking, he warned that the US dollar could no longer be fully trusted. He said the government was relying too much on debt and money printing, and that this could cause serious problems. Buffett is known for buying when others are scared, but this time he was the one getting ready for danger. His message was clear: cash is king again, and big risks are coming. Buffett's move isn't just about avoiding losses, it reflects a broader market shift now mirrored across institutional strategies. Every time the probability of a hard landing ticked higher, capital flight accelerated toward money markets, cash equivalents, and short-duration treasuries. It was not a passive hedge, it was a full retreat. Money market funds in the US now hold over $7 trillion, the highest in history. What began as a risk-off strategy has evolved into a deep structural reallocation, one that screams the smart money doesn't believe the soft landing narrative. Why? Because something is clearly rotting beneath the surface. In the first quarter of 2025, the US economy didn't grow, it shrank by 0.3%. That's not a soft landing. It's the ground starting to crack. Real consumer spending is fading. Warehouses are overflowing with unsold inventory. And the bond market, that ancient oracle of economic reality, is flashing warning signs louder than ever. The 10-year Treasury yield has quietly climbed above 4%. 5%, and yet long-duration bonds are finding fewer and fewer buyers. The June 2025 Treasury auctions were a disaster. Multiple bid-to-cover ratios missed their mark. One auction saw over $119 billion in government debt barely find a home. The US government, it seems, is running out of willing lenders. This is no small concern. September is shaping up to be a reckoning. Nearly $9 trillion in US treasuries are scheduled to mature, unless they're refinanced at far higher interest rates. The risk of technical default or at minimum yield. Shock becomes a legitimate threat. And if investors demand even higher premiums to roll over maturing debt, the fiscal math collapses. The markets know this. That's why liquidity is king. The Dow and S&P can put on a show, but behind the curtain, capital is panicking. Corporate treasurers are racing to shore up cash. Reserves, bank lending is contracting. Even the Federal Reserve is inching toward a liquidity-enhancing posture, despite the public insistence that the economy is resilient. According to the Federal Reserve's April survey, banks reported that they tightened lending standards and saw weaker demand for commercial and industrial loans and for commercial real estate credit in the first quarter of 2025. In parallel, an S&P Global report noted that while total loan and lease balances grew only 0.5% in the first quarter, this marked the slowest loan growth in 14 quarters. The report also highlighted banks hoarding cash. Median cash reserves rose 11%, suggesting reluctance to extend new loans. And here lies the paradox. How can the economy be strong if investors are behaving as if catastrophe is around the corner? Why are capital flows fleeing duration risk? If the landing is supposed to be soft, because it isn't, it never was. This cash hoarding behavior isn't rooted in fear. It's rooted in expectation. The expectation that something wicked is on the horizon. The bond market is broken. The Federal Reserve is trapped. That fiscal policy is out of bullets. And that when September arrives with trillions in debt to refinance and no cavalry in sight, the consequences will follow, and when it does, the entire game changes. Let's talk about how dangerous the US debt is in 2025. Interest on the national debt has exploded past $1.1 trillion per year, officially surpassing the defense budget, Medicare spending, and even the combined outlays of most discretionary departments. Let that sink in. The United States now spends more just to service its existing debt than it does on its entire military-industrial complex. This isn't some temporary anomaly. It's structural, it's accelerating, and it's completely irreversible under the current fiscal policy. Here's the disturbing reality. Interest costs now account for nearly 20% of all federal tax revenue, and if a recession strikes, causing revenues to drop while refinancing costs spike, interest could consume everything: Social Security, defense, education, infrastructure. Everything else becomes negotiable. Debt servicing becomes the first line item on the budget, not because it's a choice, but because it's the law. Treasuries must be paid first in any other nation. This would trigger market collapse, bondholder panic, or an IMF intervention, but the United States has been insulated by its role as issuer of the world's reserve currency. Until now, the cracks are visible. Foreign demand for US bonds is fading. Japan, the largest holder of treasuries, has been trimming its exposure since the fourth quarter of 2023. China, once a proud creditor of American fiscal irresponsibility, is now a net seller, and US banks, therefore, their balance sheets are clogged with unrealized losses on long-duration treasuries, thanks to 500-plus basis points of rate hikes since 2022. And the math gets darker according to Congressional Budget Office projections. Interest payments will hit $1.4 trillion annually by 2033. That assumes no major recession, no unexpected rate shock, and no emergency spending. In reality, we could see that number in 2026. That's how steep the slope is. The United States is skiing downhill. Yet the political class pretends this is sustainable. Bipartisan agreements on deficit reduction are dead. Entitlement reform is radioactive, and tax hikes are political suicide in an election year. So the only path left is more borrowing to pay off old borrowing. This is a debt Ponzi scheme wrapped in red, white and blue, and just like every Ponzi scheme, it collapses the moment new investors or buyers of US debt refuse to show up. And that breaking point may be just months away. The debt has entered what even centrist economists now call the lunatic danger zone. It's no longer about ratios, theories or spreadsheet forecasts. It's about momentum. Once a debt spiral reaches critical speed, it becomes self-reinforcing. The cost of borrowing rises, refinancing becomes harder, and the system begins to cannibalize itself. Credit markets tighten, entitlement programs buckle, and eventually even the dollar starts to lose its anchor. Ask yourself what happens when the world's safest asset becomes the world's largest liability. When a government is drowning in debt, but default is unthinkable and austerity is politically suicidal. Only one ancient trick remains. That trick is called financial repression. It sounds like economic jargon, but don't be fooled. This is not some obscure academic theory. It is the single most dangerous weapon in the Federal Reserve's arsenal, and it's already being quietly introduced. Financial repression is simple in its brutality. It means holding interest rates artificially low while allowing inflation to run hot over time. Inflation silently iridesces the real value of government debt. Savers are sacrificed, retirees are punished, and capital is trapped. The goal isn't growth, it's survival. This is debt liquidation through stealth theft, and the Fed is already halfway down this path. Look at the signs. While the official federal funds rate sits between 5.25% and 5.5% real yields, those adjusted for inflation have recently dipped back into negative territory on short-term debt. The Fed knows inflation isn't dead yet, even though headline CPI cooled to 4% in May. Core inflation remains at 2.8%, and services inflation is proving sticky, but the central bank can't raise rates further without risking the treasury market and triggering instability, right when markets are already strained by the largest wave of maturing debt. In US history, timing couldn't be worse. So what's the only viable path? Inflate the debt away quietly behind a mask of credibility. The idea is deceptively elegant. Keep rates below inflation, borrow and devalue dollars, and hope the public doesn't notice their purchasing power. Melting, it's worked before, most notably during the post-World War II debt unwind. But here's the catch: that era had 4% GDP growth, a manufacturing boom, and a demographically young population. Today, America has the opposite: low productivity, deglobalization, and a rapidly aging population whose retirement savings are being torched in real time. Financial repression is not a long-term strategy. It is a time-buying measure, and it gets worse for nearly a century. The dollar has been the world's reserve currency, the oil of global trade. The asset of last resort. Central banks hoard it, companies invoice in it, and developing nations depend on it. But what happens when the dollar itself becomes unstable? What happens when America's debt machine becomes so bloated, so volatile, that the dollar no longer inspires confidence, but fear? We're already seeing cracks in that foundation in 2024. And 2025, central banks bought more gold than any year on record, not because they're bullish on jewelry, but because they're quietly hedging against dollar dependency. China and Russia have accelerated their de-dollarization campaigns. The BRICS bloc is actively exploring alternative settlement systems and even a commodity-backed currency, and quietly even US allies are beginning to ask a dangerous question if they can afford to trust the dollar. Forever currency traders wouldn't weight the dollar index, DXY, still hovering near its highs. As of mid-2025 would fall sharply, a 10 to 15% decline in the dollar. Could seem orderly until it isn't. Emerging markets that owe debt in dollars would default. Global commodity prices priced in dollars would soar, and inflation would return not just to America, but to every economy attached to the dollar. Remember, the US doesn't need hyperinflation for the world to lose trust. It just needs monetary inconsistency. The Fed says it's fighting inflation, but simultaneously cuts rates. The Treasury says it can manage the debt, but demands $2 trillion in new borrowing every 9 to 12 months. Markets are watching, and the illusion of dollar invincibility is looking thinner by the day. This erosion of confidence wouldn't be abstract. You'd feel it every time you bought imported goods. Multinational corporations would scramble to hedge currency. Exposure capital would flee from dollar-denominated assets, and even US tech giants, once untouchable, would see their valuations reprice overnight. In the worst-case scenario, a dollar collapse could trigger a new era of monetary multipolarity, where no single nation controls the rules and global currencies compete for dominance. That's exactly what BRICS nations are preparing for. It might sound fair, but history tells a darker story. Transitions like these are rarely smooth. They're chaotic, disruptive, and often violent. The real question isn't whether the US can save the dollar. It's whether the world is ready for what comes after it. September could be the moment everything changes. Make sure you're ready. Subscribe now and don't miss our next breakdown. Global developments together. Don't forget to subscribe to our channel, turn on notifications, and like our content to stay updated. Volkswagen, the German automotive giant, has shelved its production plans in California while planning the first steps of its e-mobility strategy outside Europe. With President Donald Trump's proposed 25% tariffs on new cars and additional steel and aluminum tariffs on the table, Volkswagen's finance team repeatedly added the phrase non-static costs to its risk presentations. The decision, announced in early March, will see a $4.5 billion gigafactory rise in St. Thomas, Ontario, with cell technology coming from Germany and the supply chain utilizing Quebec lithium and nickel reserves near the North Pole to address range issues from the outset. The Canadian government's 15% investment credit, combined with its green electricity commitment, showed savings of tens of millions of dollars when compared to the union negotiations that were mandatory on the American side, and the decision was sealed. Stellantis is actually a player born in Detroit's backyard. However, despite its historical ties to Chrysler, the decline in conventional motor vehicles has brought it back into focus. The company has agreed to add another $4 billion Canadian dollars to its flexible cell facility in Windsor, which it operates jointly with LG Energy Solution. The key motivation behind this move was once again the risk of a shock from customs tariffs. Renewed Made in America battery content rules in the US have complicated the debate over what counts as domestic, while Ontario's critical mineral waiver has increased process security. In addition, regional unions quickly closed the table with a 5-year wage peace protocol. The UAW's 2 strikes in the US were one of the most prominent examples of the consequences of this situation. Ultimately, Stellantis knows it won't have to pay extra taxes when it exports tons of cells to the US. That's because there are still loopholes in battery exports between Canada and the US, and the company is exploiting them to its advantage. In the technology arena, Amazon was the first to open the door. The Seattle-based giant quietly acquired a vast flat area just north of Calgary. The 460,000-meter distribution center includes a test platform for autonomous trucks, a drone hub, and the region's first fully electric truck park. While the Snohomish project in Washington state has been stalled by environmental objections and a 2-year permit delay, Alberta has granted year-round approval. Wind credits have been activated on the energy side, and a carbon tax exemption has become a gift that will boost Amazon's ESG ratings. Additionally, U.S. egg-rich companies may face new competition from Chinese-led innovations tailored to extreme environments. Technology that could eventually reshape farming in aid regions across the American Southwest. China is exporting its breakthrough rice on sand technology to the Middle East, building on prior success in Xinjiang's deserts where annual rainfall is below 50 millimeters. The method includes turning sand into soil using organic benders, precision underground drip irrigation that saves up to 90% water loss, and AI-integrated monitoring systems to control pests, moisture, and fertilizer use in real time. In the US, this method sparks curiosity for its potential in drought-stricken states like Arizona or California. With water becoming an increasingly scarce and politicized resource, these low-water, high-yield systems might present new pathways for sustainable agriculture in the face of climate uncertainty. To support these agricultural ambitions, China is building the 4th phase of the Rabigh desalination project in Saudi Arabia, a high-tech facility valued at $800 million. Once completed, it will deliver 600,000 cubic meters of clean water daily using cutting-edge RO filtration, with costs down to just 2.3 yuan per cubic meter. The plant will provide drinking water for over 2 million households in Mecca and Medina. For Americans, this project shows what large-scale desalination can achieve when energy efficiency meets engineering. As coastal states like California debate desalination's viability, China's model presents a cost-effective solution that might soon become essential not just for agriculture, but for basic urban resilience. Once the world's 6th largest wheat producer, Saudi Arabia halted domestic farming in 2016 due to depleting groundwater and unsustainable costs. Now backed by Chinese expertise, the kingdom aims to revive cultivation across 3.5 million hectares of dormant but arable land, just 1.6% of its territory. For American audiences, the move is symbolic. It represents how technology and geopolitics intersect to challenge long-standing ecological limits. If desert farming proves viable, it could change the global agricultural map and offer inspiration for how U.S. regions with marginal land might be reimagined in the future. A new global tech power shift is unfolding from chip wars to trade barriers and domestic economic pivots. Could Western policies be accelerating the very outcome they aim to prevent? NVIDIA CEO Jensen Huang has urged the U.S. government to lift export restrictions on advanced AI chips to China. Once holding 95% of China's AI chip market, NVIDIA